Short discussion on income tax deductions. Income Tax Act 1961. Lesson 16. Deductions to be made from total income continued. Last time we have seen the deductions to be made from total income. This part is going to be continued as a short discussion. Revision of or recalling of the work done previously on deductions to be made from total income of an assessee. Good morning, everybody. I am Mr. T.B.Agarwal, retired income tax officer, speaking from Agarwal Income Tax Tuition classes, Akola. In the previous lessons, we have studied the various deductions to be allowed under Chapter 6C, that is under sections from 80C to 80U, from gross total income of individual and HUF assessees in order to arrive at the taxable income. We have also studied the previous lessons that there are 5 heads of income, and to compute the income from each head, some deductions are to be allowed to decide the income from that particular head of income. While computing the income from salary, we have to take into consideration the deductions as under, that is under section 16. 1. Standard deduction of 50,000 rupees. 2. Employment tax paid by the assessee, that is from by the employee. And 3. Entertainment tax as applicable. We have seen that while in employment, one has to incur certain expenditure for vehicle, books or repairs of our vehicles and petrol, etc. In computing the income from business or profession, deductions for depreciation on car, scooter, other vehicles and expenses for shop, insurance, telephone, newspaper, salaries of servants and workers, etc. are allowed, which are for the purpose of business or profession, but these are not applicable or allowed to salaried employed. This we have already seen. Therefore, in order to compensate the expenses required to be incurred by salaried persons, standard deduction is allowed from salary income. This we have seen in the respective lesson on income from salary. While computing income from house property, the deductions allowable are that they are under section 24. 1. Taxes levied by the local authorities paid by the owner. 2. Standard deduction of 30% of the annual value. 3. Interest paid on borrowed capital for purchase or construction of the house property, etc. This is because where there is income from property, there are some expenses also. The landlord has to pay taxes on the property, pay insurance premium for the property, spend for repairs, etc. Thus, for these expenses, standard deduction and other deductions are allowed to arrive at the income from this head. This we have already studied in lesson on income from house property. In computing the income from other sources also, we have seen that the deductions for expenses for earning the income are allowable, and also the deductions from family pensions at 15,000 rupees are allowable to arrive at the total income from this source of income, that was under section 57. These have been discussed in the relevant lessons along with the reasons as to why these deductions are allowable. Likewise, there is also a mention in the previous lessons that deductions for expenses for running a business or profession and expenses for repairs, insurance paid for protecting the goods and the shop buildings, and for telephone used and light bills paid for the purpose of business or profession are allowable from these incomes, with depreciation on plant and machinery used by the assessee for the business carried on by him. Those deductions are under section 30 to 37. The deductions which are to be allowed in computing the income under the head capital gains have also been thrown light upon. In computing income under this head, expenses for commission paid or to decide the acquisition cost or development cost of the property, cost inflation index is to be applied to arrive at the real profit from the sale consideration, etc. This is under section 57. However, these deductions will be considered while studying the chapters of income from business or profession and income from capital gains in details. The deductions for expenses are allowed before computing the total income for knowing the net income from each source for taxation, and these are for earning the income and coming to the total income from each source or head separately. Here we have seen that though the revenue or business or relevant expenses are deducted from the income, still the expenses of personal nature or of the nature of capital expenditure are not allowable under the Income Tax Act. Now a question may arise as to when all deductions are already granted and then the total income is computed, and when personal expenses or capital expenses are not allowable for computing the income of the assessee, then why again the deductions for LIC paid or expenses incurred for medical treatment of the assessee or her parents or children or family members of HUF, or of the amounts given by the assessee as donations to some charitable institutions or temples, etc., or payment of tuition fees of children, or investment made in FDR or time deposit scheme, or in purchase of particular bonds, etc., are allowed to the assessee after the total income is computed. These can also be called as personal expenses and personal investment of capital nature going to be saved as a capital or assets of the assessee. LIC may also be called an investment for future personal arrangement or gain in case of happening a certain casualty, and why a separate chapter for allowing this deduction is prescribed in the Act. In this connection, it may be stated or clarified here that there are two types of deductions. One for arriving at the total income from each head of income. The income from each head is computed separately, and all the incomes from all heads are aggregated or total together, and that is called gross total income. These deductions are allowed before arriving at the income. The second type of deductions are the deductions under Chapter 6A, which are allowed after the total income is computed. The deductions under Chapter 6A are though may be for expenses of personal or capital nature, are allowed to develop the saving habits of the assessees and also to increase long-term saving of the assessee, and also to encourage or enable them to fulfill their personal responsibilities towards own family members and to accomplish the responsibilities of educating children and make some suitable arrangements for their life. The assessees are also allowed deductions for donations to religious cause, to non-profit agencies, to humanitarian and governmental organizations, etc. By doing this, the assessee not only fulfills his or her responsibility but also helps the cause of nation by grant of donations, which leads to the betterment of the society. This is to entice the taxpayer to participate in community service program for betterment of the society and the nation. Further, it is not that always the assessee will get or earn profit from business or profession or get benefits on sale of capital assets, etc. Sometimes the assessee has to sustain losses also. The assessees have to suffer losses in business or on sale of capital assets, or have to pay more interest on borrowed money for capital for running the business or on house property, etc. Therefore, the assessees are given opportunities to compensate the losses suffered in earning income in the assessment year itself or in the coming years to enable the assessee to be active in running the business or his earning activities. The setting up of the loss against income or allowing the loss to be carried forward in the next year and set off against future profits or gains is also one type of deduction to encourage the assessee. This lowers down the tax liability of the assessee. Therefore, the deductions are allowed to progress the assessee of their own business or go on increasing their life facilities in the life. This will be studied in separate lessons on carry forward of setup of losses. Thus, we have seen that there are standard deductions and itemized deductions which are allowed to the assessee in the Income Tax Act 1961. This is just to recall or remember the previous lessons and to see the purpose of allowing deductions even after the total income is computed. Now we will turn towards the next chapter about the income tax authorities and their powers in the next coming lectures. If you like this video, then please press the thumbs up icon and subscribe the channel, which is free of cost, and please press the bell icon next to it to get the notification of my next video. Thanks.